Good morning. It's Monday, the 22nd of July, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, but in transit right now. Before I come to the take, my episodes for the next 8 days will be intermittent and shorter as I'm away for a conference. I also have a few longer interviews lined up, so stay tuned for that. And the take. Last week was a good one to remind us how technology rules our lives. My own flight was delayed by several hours because of delays caused by computer systems breakdown. Working backward, now you know which airlines or organizations depend on Microsoft for their operating systems and which in turn use the Austin-based CrowdStrike's product for cybersecurity. It was an update of this CrowdStrike software which caused the Microsoft Windows systems to freeze all over the world. Microsoft said that their estimate was that CrowdStrike's update affected 8.5 million Windows devices, or less than 1% of all Windows machines. But that doesn't really make a difference, at least to you and me, if we were delayed and waiting in airports in the middle of rain like it was in cities like Mumbai. CrowdStrike sits on Microsoft's Azure cloud infrastructure or connects to it. But between Microsoft, Google, and Amazon and their cloud computing businesses, vast amounts of data of the whole world and particularly businesses lie on their servers wherever they are, which is a monopoly challenge that has to be dealt with, but not easy to, because scale creates efficiency, reduces cost, and improves, at least theoretically, the quality of the product or service, obviously, up to this point. The other moral of the story, a software like CrowdStrike might protect you from external attacks and threats, as it seems to have done, as and when they come, but not from itself. And of course, more importantly, human failure, which includes the possibility that someone just did not do those multiple checks before releasing the update, or why did they not roll it out incrementally rather than one big dump? Which of course is a good time to remember that there are an increasing number of devices we depend on in our daily lives which are updating all the time, from our phones and computers to those who have electric cars and other appliances. In most cases, we have the choice of accepting an update, so we know something could go wrong, but we would not have a way out of it either way. CrowdStrike was an auto update, by the way. Not that it could be anything different given the nature of businesses who run 24/7 on such systems. So the bottom line is we're more connected than ever before. We also have to remember what our lives would be like if we were not connected. If there was no core banking systems running our banks who in turn were not connected to each other, we would be running to physical bank branches. By the way, I'm old enough to remember that, to stand in lines to deposit or withdraw cash or just check a bank balance. The UPI system we feel so proud about, which allows instant fund transfers of the smallest number of amounts by scanning a QR code or via our mobile phones or by just keying in a phone number, means there is something which is connecting all of this on databases, and to use that oft-used, even dreaded word, cloud. Most of the mail systems we are using here in India are sitting on servers or controlled by organizations in the Bay Area in California. But remember that none of this, including our ability to access our bank accounts or do transactions, has really suffered in all these decades of centralized databases. Yes, there have been occasions, but very rare overall. All of this, and that's the point I want to get to, is a function of people as much as technology. There is, of course, that element of trust which we willingly or unwillingly confer upon these organizations. So I guess it comes down to how much. How much data do we store and where? If a bad update from CrowdStrike can cripple systems, remember, only that use them and Microsoft operating systems, then how should we be thinking about it, as in thinking about such products and services? What about the future? Should such companies be local, so problems are localized and we're actually prepared for external cyber attacks, which, by the way, are happening all the time? I'm not sure. The best talent creates the best software, whether for driving various functions within an organization or preventing cyber attacks of the most sophisticated kind. If CrowdStrike were to be proved incompetent and worse, unreliable, other players would take over, and there are enough hungry sharks swimming in the vast technology ocean. Of course, we need regulation to ensure we can switch service providers easily and efficiently if we don't like one. We should not be switching, for example, from Android to iPhone or vice versa. The fact that you have common charging jacks for at least iPhone and Samsung phones, the latest ones, did not happen by accident, let me assure you. I'm sure many enterprises are asking these tough questions to themselves right now and since the last 2 days. How do we protect ourselves from similar failures next time? It does not matter the breakdown was triggered by an external attack or an internal human failure. The outcome is the same, which is that businesses will lose business, customers will be inconvenienced, and reputations will be hurt. I could blame the software provider for the fact that my fleet of aircraft was grounded this morning, but my customer does not care, and that is my responsibility. I want to highlight the point of talent again. It's only the smartest brains that will produce the best and most reliable product. We have to zero in on them and work with them wherever they are in the world, at least for the businesses that can, and make sure that they're delivering a trusted, reliable product. We also have to ensure that we have the smartest people overseeing this, like we have in some of the top banks in India. Make no mistake, it is not an accident, once again, that we don't have breakdowns and data hacks, at least at scale, in the Indian banking system, or for that matter, the capital market regulatory system or capital market system so far. But more importantly, we should retain our trust in technology and depend on it to deliver services we need to make our lives better. But like everything else in life, we need a small plan B too. And our top stories and themes for today: the stock markets are weak as technology takes a beating and the budget is weighing on stocks. And our controls on overseas investments that's out of India slowing down flows.
This is the Core Report with Govindraj Ethiraj.
Markets plunge on tech beating. It's not just the Microsoft CrowdStrike outage which crippled businesses across the world, from airlines to hospitals, that reminded us how vulnerable the tech industry was. Tech stocks took a beating too on a wide range of concerns, but primary perhaps was the one that the sector was overvalued. The Nasdaq 100 index had its worst week in 3 months, says Bloomberg, adding that after driving the rally in US stocks for most of the year, big tech slammed into a wall this week. Ouch. The concern that tech and within that artificial intelligence and within that stocks like Nvidia are overvalued is not going away on Wall Street. Artificial intelligence darling Nvidia sank about 9% last week, while Amazon was down about 6%. Yes, we do think of Amazon as tech because of its vast cloud service portfolio, or Amazon Web Services, which controls about 32% of the global market for cloud and represents 17% of its own revenue, according to reports quoting Synergy Research Group of the US. So if you're thinking Prime Day sales, well, that's not what is driving the stock. Wall Street feels the big tech giants' profit growth will be slower this year. Back home, the union budget tomorrow is also weighing on investors. There is some speculation of whether or not some of the tax slabs on capital gains on income earned from sales of assets, including stocks, will be shifted around. More on that in a little bit. I can also see some stockbroking research reports, evidently the beneficiaries of some informal briefing, preparing the ground, at least statistically. Now, this does not mean it will happen, but it's clear that the waters are being tested. On Friday, the BSE Sensex fell about 739 points to end at 80,600, and the Nifty50 was down at 24,531, down 270 points. And then, no surprises, of course, the indices hit record highs again on Friday, hitting 81,588 and 24,855 in morning trade. The BSE mid-cap and small-cap indices fell more, almost 2.5% each. The big theme to prepare for, in some ways, will be regulation. We have often discussed how the regulators, for example, the Securities and Exchange Board of India and the Reserve Bank of India, are debating and wondering and scratching their heads on how to cool down a heated market for stock market investments as well as loans. It is inevitable that more curbs will come, as they should, in addition to the few that are already there. The rising volumes in the derivative segments have now become a macroeconomic issue instead of being a risk concentrated to only a few individual investors, Madhabi Puri Buch, the chairperson of the Securities and Exchange Board of India, said last week. Her comments come at a time when financial regulators have cautioned against the rising euphoria in the futures and options segment, where daily turnover has shot up to nearly 400 trillion rupees in notional terms. We referred to this last week as well, and these are clearly figures you cannot wrap your arms around, except that India has now some of the highest volumes in derivatives in the world. Buch highlighted the unanticipated surge in the volumes and loss of household savings to speculative activities, and that's a point that the core has been making consistently in recent months as well. According to her, and I quote her, many young people who've entered that market have lost tons of money. Nobody could have expected that. It has now reached a state where the micro objective of protecting the individual investor has to change to thinking about the macro issues. At a macro level, we are worried that the household savings are not going into capital formation but into speculative activities. Elsewhere, Reliance reported first quarter profits last week below analyst estimates on Friday, and that was hurt by lower margins on fuel sales, according to Reuters. Reliance's consolidated profit fell to about 15,000 crore rupees, that's about $1.8 billion in the April to June quarter, from about 16,000 crores a year earlier. Analysts had estimated a profit of about 16,287 crores. That's actually more than what was last year. The oil to chemicals company's earnings before interest, taxes and depreciation fell 14% thanks to lower transportation fuel cracks, particularly gasoline cracks, which were down 30%, Reliance said in a statement. The company said that the business was impacted by lower fuel cracks with tepid global demand and ramp up of new refineries. Now, Reliance is a key Indian buyer of Russian crude oil sold at a discount and has signed an annual oil purchase deal with Russian oil major Rosneft, according to Reuters. And as we've been pointing out, the discount on Russian crude has reduced quite sharply in the last few months. This will surely affect the margins for oil companies, whether it's Reliance or the government and state-owned ones like Indian Oil, BPCL, and HPCL, and something that we've been consistently tracking here. Meanwhile, Reliance's consolidated revenue gained 12% to about 236,000 crores or 2.36 trillion rupees. Reuters points out quite correctly and importantly that Reliance's Jamnagar complex, located in Gujarat and the western coast of India, which houses two refining plants with a combined capacity of about 1.4 million barrels per day, is at the core of its oil to chemicals operations, making it a key profit driver despite the company's aggressive expansion into retail, telecom, and green energy. And this is something we've discussed here in the past as well. Reliance's pot of gold is still in oil and not in data at this point. Speaking of oil, Brent crude is now quoting around $82.63 or under $83 a barrel, weaker than it was last week. Thank you for listening and your support for the Core Report. We've been streaming for a year, and we think this is a good time and ripe for a quick feedback from you on what we can do new and better on this podcast. And thank you, as always, for some good critical feedback. The link to a short survey is in the show notes. India's reserves are at a high. Investing overseas should be easier. More money is diversifying out of India as wealth is generated, and investors look for options globally, geographically, and across asset classes from stocks, bonds to real estate, among others. There is nothing unusual in this. Most wealthy will want to diversify their wealth across geographies, which is also a good thing because when markets and economies go up and down, as they always do, they're able to move their capital or bring it back and thus keep the engines of enterprise running smoothly. The government, of course, is uncomfortable with this, with too much capital, in its eyes, going out of the country, given our own history of currency crisis. But with the current reserves at about $667 billion, which is a record high, by the way, we should surely focus more on the enabling environment to bring in capital than focus on controls to stop it from going out. The freedom of movement is what brings capital in the first place, and India in the last 3 decades at least has not seen any outflows, at least at a level that could damage the economy. If anything, it's always been net positive. So one of the niggling aspects of controls is the government's move to impose a tax collected at source, a presumptive tax which is refundable, but nevertheless increases your cost of acquisition, or for that matter, even if you were traveling overseas where you put a certain amount down. There is some hope that the Union Budget 2024 will look at this, but seems unlikely. So how is tax collected at source affecting flows in general? What is our takeaway from its implementation so far? And what are investors who are diversifying looking at? I spoke with Rajanya Ravasia, wealth manager and founder of Adventum Group, based between London and Mumbai, and which advises investors on investing mostly in real estate in countries like the United Kingdom, which he feels is attractive and provides good return on capital, but is also constantly looking at options in other markets. I began by asking him about the impact of TCS and how he saw asset flows in the near future.
When we look at the liberalized remittance scheme in the context of from when it was first allowed, and that, probably 10, 15 years ago when they started the scheme, I remember in 2010, the cumulative liberalized remittance scheme number was about $2 or $3 billion. It was a very, very small window that very few people exploited. And if you look at the component of why and where is the LRS scheme most used, although it is a scheme that is, effectively a very, very democratic scheme that every Indian national or citizen of India can utilize, are not even age restricted, if you're aware, right? A child also could actually remit using his own entitlement to the remittance. The scheme was never really exploited, if I can use the word, or utilized by many. The largest use of liberalized remittance scheme even today, and from the 2-3 billion that it was, just to give you a sense, the total cumulative number for 23-24 was in excess of 31 billion. So it has exponentially grown in terms of the utilization. Obviously, if you look at the number of remitters from India, there is a very small number that utilize the entire 250. So obviously, it speaks of a bent of mind that I want to sort of diversify all the capital that I'm allowed to diversify, right? That becomes the sort of conclusion. But the end use of the liberalized remittance scheme today, and of course, it's allowed for practically any end use that is bona fide, barring gambling and trading in foreign exchange and all of that. It's broken up into either a capital account, which is investments, or it is spent or can be consumed for expenditure. I would think from the data that I've seen, 90 or 95% of the utilization of the liberalized remittance scheme is towards expenses. The reason I'm actually backtracking the end use is to give you the better answer to the implication of TCS. Expenses, again, can be broken up into foreign education, which is actually the second largest reason for remittance. The largest reason still remains travel, whether it is corporate or personal holidays. Travel is the largest item on the NRS reason for outbound remittance. Next comes education. Third is medical care, if there is that people need specialized medical care, etc. And maintenance of family and friends overseas. It is only 10% of this value. So, when you're saying 30 billion a year or 31 billion last year, we're looking at about $2.5 billion US dollars of outflow, of which less than 200 million is actually utilized. So 10% is utilized for what we call investments, right? Now, within investments, we have, it could be bonds, it could be parking into fixed deposits, it could be, investing into the US equity market, which of course has been doing well, like all equity markets around the world, especially post-COVID. And it could be investments in other companies or property. And of course, we, as you know, deal largely with the diversification of Indian capital into property, which are rent yielding. And that, of course, is a different rationale and a different math and a different allocation of wealth. But coming back to, therefore, understanding the allocation of where LRS has been used or is being used currently, we would think that a lot of the uses of LRS are pretty much inelastic, or they are not absolutely discretionary, if I can say. I mean, if I have to educate my child and if my goal is to educate him or her in the US or outside India, I am going to land up spending that sort of dollar exchange. Now, if you know the 20% TCS only applies to certain applications of LRS, and education seems to be exempted for that, right? A lot of that LRS, especially for education, also has an opening where you could take a student loan here and actually remit the money. So that falls under the reduced TCS of 5% even today, and not the entire whack of 20% that otherwise LRS remittances are subject to. So even the government realizes that there is a need for people to spend that money, and we can curtail in aspects that are absolutely discretionary or luxury by government definition and put a tax on that. Now, if I have to backtrack, and TCS has only been implemented over the last maybe 24 months now, I think it is a direction in the right sense that you don't want anyone with liquidity in their bank account to just remit it out and then be found that, this person owed tax to the government and now he's not liquid and he's also sort of gone away from the country, right? So for anyone who's bona fide, who's genuine, yes, there is a bit of a load, like you said, at the time of remittance, but it's something that you're going to get credit back for. So it's not a cost, it is a cash flow management situation.
Okay. So can I flip the question around now? As an asset manager, what do you feel are, let's say, the good investment opportunities for someone who's saying that, okay, I'm going to allocate in India about 80%, whether it's equity, debt, real estate, and so on. And then I'm looking at overseas. So how do things look today, right now, at this point of time, given how, in general, how assets are rising or asset prices are rising all over the world?
I think prudently, any wealthy person must have an allocation to, let's say, gold, to equities, to bonds, stocks, and real estate, right? For various reasons of managing risk and reward. I think Indian real estate in this context, and I'm not talking of consumption, which is your own home or your own office, which of course you can own because you use it. And there's a long-term value, that is inflation beating. Investment in real estate, Govind, is a very, very different subject matter. See, traditionally, the Indian real estate has been marked with a lot of cash dealings and all of that, and that may have been incentives, therefore, to park when you don't know where else you can park this cash in, right? I think the government has taken very, very good steps over the last 8-10 years to be very, very proactive in maintaining transparent records of transactions to keep that ready reckoner, pretty much aligned to current market rates. And I think mature places like Mumbai real estate, which I'm so very well accustomed to, I don't think there's any space to actually buy or sell in cash because the ready reckoner is very close to deter that kind of transaction from happening. But leaving that aside, if someone is saying that I'm going to invest in property to make money, then first of all, it's an Indian asset, Govind. That means it's Indian rupee denominated, depreciating against the currency, which is the US dollar. So you're automatically losing about 4%, 3.5%, depending on how you peg it. If there is a borrowing cost attached to acquiring this property in India, and even if there is physically no loan, but there is a notional cost of capital, right? And we benchmark that to a home loan at a 8.5%, 9%. We are now losing 9 plus 4 of currency. We are minus 13 and potentially making only a 2.5%, 3% in rental in residential, right? So we are pretty much clocking a minus 10 every year and only basing that investment on speculative growth, that my price will rise and I will make up for 10 plus growth, right? Now, the first 10 is only taking care of cost. And to expect real estate year on year in India to deliver more than 10% growth is, I think, a fallacy. I don't think it happens. If you look at the property cycle in India, it's a 10-year cycle. And you live in Mumbai, I think you obviously are witness to pricing and costs here. If you look at the market from 2010 to 2020, I think the market was pretty much flat. So you were incurring that 10% cost with no gains on price. Right? So you're losing money every single day. The Indian property cycle is a 7-8 year flat market with a jump in 3 years. And again, it becomes flat, which means that it's a trading market that you try to time your entry and then you must try and time your exit as well so that you make money in the shortest amount of time, giving you a profit. Vis-a-vis, if you look at certain international markets, we, of course, as you know, are very, very strong in the UK property investment side, on the UK property investment side. There, the graph is a standard 4 or 5% capital growth year on year. And I'm talking tier 2 cities, not necessarily London, which is a product and an influence of global capital costs, which is not true of actual home buying and home occupancy, which is more prevalent in other parts of UK. But moment you take a graph that is growing by 4 or 5% every year, your entry point and exit point does not need to be so closely timed and monitored. Any point you can enter, wait a while and exit, making it an investment market. Now, if circumstances allow where you could actually borrow overseas, given that you're a non-resident Indian or you're structuring this on the shoulders of someone who's non-resident in the family, then your cost of capital may be 3 or 4% in terms of borrowing against that property, and you would generate rental yields of 6.5, 7. So the rental market is much more buoyant than it is here in terms of yields. The cost of borrowing against that asset is much lower, and you are in a currency that is appreciating against the rupee. So if you take that 4% loss of dollar as a profit on dollar, you have 4, you have another 6 on rent, making it plus 10, and you have a borrowing cost of just 4, giving you a plus 6. Plus capital growth of 5, let's say a year, making it 11, 12, 14% profitable investment story. And what we pitch, Govind, as a wealth manager for real estate, is that this is pretty much the stock market return you're getting in India, but with a lot less risk.
Right. Is a lot of the outlook based on currency fluctuations or the role of currency?
It is not, but the way I would pitch it is, if you're buying an asset, simple, 400,000 or 4 crore property here versus there, your simple rental yield is 6.5 versus 2.5, right? So net, you're definitely 4.5% better off. Number one. Number two, capital growth is a lot more predictable because of the shortage of UK homes, which is a global story. Their backlog is about 1.5 million homes. So your capital growth is assured. And you can take the currency as a tailwind that if you're buying property which will hold for 5 to 10 years, we don't know whether it will be 3 or 2 or 5, but net 10 years later, that pound is going to be more expensive than what you bought it at today.
Right. Rajan, thank you so much for joining me.
Thank you so much, Govind. Pleasure speaking here. Thank you.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.